can we be more bullish than we are right now? And are we going to pull back? What kind of week are we going to have next week with earnings coming up, with all this data starting to pile up, and economic data as bearish as it's been, and as gloomy as the outlooks have seemed to be for the economy as well as for this particular earnings season? What kind of week are we going to have next week now? What do the technicals tell us? I'm going to break all that down in today's video. We're going to take a look at another stock that's had a nice little breakout today, in a sector that outperformed, in a sector that we would expect to continue to outperform, based on different intermarket relationships. So let's go ahead and get started. Today is Friday, July the 12th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 first of all here on the market forecast indicator. Of course, we continue to have strong bullish posture. I mean, this like triumvirate of dark green shading, rising green line, rising market sentiment, all three of those things we have. So we haven't had that for a while. We barely started. We got the dark green shading first, then we got the dark green line with the moving average turning higher, similar to over here. Over here, we had the market sentiment line rise first from lower levels. It took a little bit longer for the market sentiment line to get going over here, but now we have that combination, which typically leads to pretty decent intermediate runs. You look for the near-term line to also stay in the upper reversal zone, and yesterday we were kind of in the upper reversal zone, but it really got strongly up here into the upper reversal zone. So you can see that, again, that's what you want to see. We had 1 day below 50. It was a higher near-term low. We're up now to a higher high point with a higher near-term high that got up into the reversal zone. You expect it now to stay up here above 50 for 7 to 12 days. This is the first day, 2, 3. So we're 3 days into this run. Probably going to stay up here. I don't know if it will stay above 80, but it'll stay above 50 probably all throughout next week. Next week's a big week because we have earnings results, and of course that can create some volatility as earnings really starts to pick up. But that's a pretty decent size move for the S&P 500, considering that, again, when you look for it to pull back, the first layer of support you look for is the old near-term high. So here's the old near-term high point right there. So you look for it to pull back to that. That's kind of the first layer. The second layer being the old near-term low point, right? Because you break through that low, and now you have a low series of lower lows on the near-term line. So so far, every near-term peak is held on the pullbacks, on the near-term pullbacks. So you want to, during this next week, continue to push higher to higher levels that will allow you to pull back towards 3,000 or 29.99, 97 in that area, allow you to pull back to that area and hold on the next near-term pullback or the near-term line. Now we're only a month into this, so the typical intermediate rally where the green line rises above 50 is 1 to 3 months. We're a month into this. We still got potentially a couple of months left to go. Potentially, right? This isn't the first intermediate rally. The first intermediate rally was this one, and it took, it went eventually from mid-January up to mid-May. So that one went 4 months, longer than normal. So we'll probably be more in the kind of 2-month range here. Sorry, I keep having issues with my lights. So that's the expectation. And we look for that to hold it. You can see it's the same thing on the Dow. Look at the Dow breaking way up to new highs. The NASDAQ composite easily breaking up to new highs. Nothing is close to a cluster. See, that's when you start worrying about an exhaustion move, when we've been multiple months into intermediate rally, and then you get the clusters. And that means the momentum line has to get up there. And the momentum line means when it gets up there, you typically have a bigger than average range move. You close right at the high. That's what gets the momentum line to those high levels, the red line, at least high enough to get a cluster. And obviously not the case on the S&P, not the case on the Dow. You can see the Dow is still below average on the range, even as much as that looks bullish, still below average on the range. So the momentum line actually fell there. And then finally the NASDAQ composite, about half its average range. So momentum line's not anywhere close to being overbought. And the one thing we're missing here is on the Russell 2000. Its market sentiment's still falling, and it's not falling very much, but it's still falling. And so once they break out of here, then you'll see the markets really kind of grind its way higher. When I say take off, it's going to be hard to take off considering how low volatility is, right? We usually take off of low points. We don't really take off through highs. But we can make a multi-month move. I mean, like I said, the S&P is well above this high point, right? The high from over here in September was actually early October is when it peaked. It's above that high point. The Russell 2000 is not. So there's still a lot of room, depending upon sector rotation, because that's the problem with the Russell is the financial sector, the healthcare sector, the industrial sector have been lagging. And so that's put pressure on the three biggest areas in the small cap index. And whereas the biggest areas in the S&P 500 are technology and discretionary, and now getting to be more and more consumer discretionary. And those three sectors have been just killing it off of these lows here. But when you look at just today alone, small cap stocks did have a good day today. Here, let's go to the asset class, and you can see the best day was obviously the Dow again, price weighted average, but there's your small cap index outperforming by a good amount the S&P 500. So there's opportunity for the Russell 2000 to get that third leg of rising market sentiment. You would like it to get above 50, but then you'd have all four of these major indexes and averages in that strong bullish territory. All right, before we get going and looking at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also one below the video on the watch page if you're watching this on YouTube. That will notify you when these videos are posted. Also, hit the thumbs up icon that's down there. That tells me, number one, you like the video today, obviously. Number two, you want us to do it again Monday. So it's a quick way to give us feedback. It's our only feedback we get from you. So again, if you like these videos and you want us to keep doing them, one click is all we ask down there. So you can do that right now while you're watching. Also, while you're down there, comment on the video. What did you get out of it? So that people coming for the first time, they can see why they should be watching it themselves. Join our daily market outlook email list. There's a link popping out in the top right corner of your screen. Click up on that link to subscribe to our list. Follow me on Twitter for more content in between videos from day to day, and join our market outlook community that we've created on Facebook. I also invite you to subscribe to our website. If you're watching this on our blog, you can click on this link, Market Scholars, subscribe to this image. It takes you to our subscribe page. Really, very easy to subscribe. You can participate in our forums on our website as well as other content that we will create for you. Of course, our premium subscribers get access to all of our classes as well as other features as well. They get trade alerts whenever we put trades on in our classes, our trading rooms. Any trades we make in between classes, one of the features that your premium subscribers get is they get the real-time alerts on their phones, watches, desktop, whatever. So that's one of the features that our premium subscribers get. Of course, we also invite you to subscribe to our social media or engage with us on social media. We try to make it really easy for you. You can click this heart right here. That will like today's Market Outlook tweet. Click that like button. This image takes you to your Facebook page. Like it there. Again, Facebook, Twitter won't show you everything that you follow because, again, a scrolling timeline with all that's being put out there. So to make sure that you see our stuff, you need to engage with us. That's how they know. That's how Twitter knows. That's how Facebook knows. For that matter, that's how YouTube knows that you want our stuff. You want to see our stuff. So the more you engage with it, the better. And we try to make it very easy for you here. All right, back to the charts. Let's take a look at the long-term charts, which, very good bullish week. New all-time high, closing high for the week. It's the second week in a row that we've had new all-time closing highs for the week. Haken-Yashi candles look very bullish. Next week's open for the Haken-Yashi will be the midpoint between the open and the close there. So between 29.45, 29.92. So you're looking at about 47 points. So 24 points. You're looking at about 80, 29.70 roughly. Is where the open will be next week for the S&P. We're trading at 30.13, so we're pretty far up above that. Good chance that next week's candle is going to be pretty bullish too. Of course, you need to get above 1392 to get a new higher upper shadow, which is also bullish, as you can see. Of course, we're only 0.15 of a point away from that. So very good likelihood that next week's candle will be another bullish candle. Remember, we've got 5. Next week would be 6. The expectation is 4 to 13. So there's still room to get up to that 13 mark. And of course, that one was more than that one went, I think, 17. So we went that extra month that I showed you before. Let's take a look now at the 3 green arrow chart here. And of course, you got 3 green arrows. Moving average is rising. We are well above all 3 lines. When you look at the 2-line versions of them, we're well above the 8-day moving average. It's still rising. The 8 and the 17 and the 30 are all rising. The momentum is about as strong as you can get. So keep in mind that don't be surprised if that momentum or if this bullish move starts to slow down. That doesn't mean that we'll go down. As you can see, I mean, look from here, the surge occurred right here off of that low point, and then we continued higher while the MACD slowed down. So, look for something similar. Not, obviously the VIX was a lot higher here than it was coming off of this low. So it won't have as big of a move to the upside as, now as we had back here. Simply because of volatility levels. So expect it to continue to grind its way. This green line, at the beginning of this, it was what, on 618, this green line represented the 1 standard deviation to the upside. So you can see we're actually still kind of on pace. This is kind of a normal move for what the market was expecting back on June 18th. So not out of the realm of possibility at all for us to have this kind of rally to the upside. All right, now let's take a look at the intraday chart. You can see, I mean, that's about as bullish as you can get. I mean, we're at the high of the 4-week range. The low point is about at the beginning of the 4 weeks as you could possibly have. We're well above the high points there, and again, this is this week's Hakunashi Open. So now it's moved up with this is the average of this week's open and close on the Hakunashi for SPY. So that puts next week's Hakunashi Open here at 296. So again, that's the room we have to work with on any pullbacks if we get one. I don't even expect we'll get a near-term pullback next week. Obviously, we might have a down day or two. But in terms of more of an extended near-term pullback where the near-term line comes down, we're just 3 days into a expected 7 to 12 day near-term rally. So the near-term line might stay above 50 all next week. And that would just get us to 8, which would be kind of normal. But you can see, I mean, that's how much room we have to work with on the downside. Obviously, this week's low point is just above there. So we can pull all the way, and this is this week's high point. This is last week's high and low. So, I mean, we can pull all the way down to Tuesday's open, which is just above where the 4-week the Hakunashi Open is going to be. And then this is the 4-week midpoint. It's going to move up too as we clear and move really up to this level, which is about 2 points higher, which means the midpoint will move up about 1 point higher to 295.60. And again, that will be in the same area. So you'll have multiple areas of intraday support right in this area if we were to have any sort of pullback at all next week. Keep in mind that the Bollinger Bands here, there's no volume resistance above where we're at right now. That's the nice thing. And you can see that next week's, the value area of the 1 year volume range happens to be pretty much at this week's Hakunashi Open. So, again, lots of support below here and nothing really weighing us down. Now, that doesn't mean we're going to skyrocket to the moon anytime soon because, volatility is extremely low. I mean, you look at, we are down. We're finishing the week. This is one of the first weeks here on a weekly chart. Let's go to a weekly chart. One of the first weeks that we've closed below 85%, this 85 mark since, we had a couple here in April, but that was kind of after we were testing, from this kind of surge low point. We were on our way down. See now, I mean, that's similar to, I have to go back a little bit further. That's similar to where we had, this big surge. It would be this big surge that we had in early 2018. We came down, we retested, very similar to this. Then we came down and flirted with that 85%, bounced up and then stayed in that range for a couple of months. This is the type of move I expect now that we'll get here in terms of volatility. It's a really low, it's the lowest close in volatility since this May bounce in volatility that we've had. And it's not closing into extreme lows. We're not trading near extreme lows, but once you start trading around the low 80s, then you're pretty darn bullish. And you can see even here, we're getting really close. I mean, we dropped below 12.5 today. And you can see when you get really strongly bullish here or even over here, you start trading in this below 12.5 to 15 range. Ends up being your range for volatility. Oh, here was historically low. You were using 12.5 as the high point, but on your bounces, you were getting to 15. So that ends up being the new range. 15 is the high, 12.5 or 11, 10.5 to 11 as your low. Very, very tight range for volatility, which means very small and slow moves. Looking at just today's range and volume, again, half the range. Today's range was half the average. The volume here was at 40, ended up being 40 million shares trading. Again, that's very typical of a half day of trading, of a low volume half day of trading. So it's very, very, very light volume when you put it into the context here. 40 million shares is well below the 52-week the low end of the 52-week average. 1.25 points also way down here, easily entrenching the relative ATR below 1%. Again, we're bullish, and really not a whole lot of signs that we're going to be bearish anytime soon, outside of a day or two. We might get a day like this, and when we do, don't get caught up in any kind of hubbub about the recession calls and all this and all that, or whatever the case may be. We're entering a period very similar to 1995, in July of 1995, mind you, where we were hitting all-time highs after a very strong start to the year. We really didn't even have that big of a decline in 94, but we had a very strong 6 months of the year, and yet we still raised or cut rates in July of 95 as we were hitting new all-time highs. In fact, that was the last period that we've been hitting, according to Dietrich on Twitter. That's the last period that we've hit all-time highs and cut rates. So because of that, people think that doesn't happen. Well, it happened quite a bit between 1980 and 96. We had a lot of opportunities, according to his tweet, where the Fed cut rates. In fact, I think he said there was 20 in that period, in that 16-year period, 20 times where the Fed cut rates when the S&P was within 2% of its all-time highs. Because it hasn't happened since 96, people think it never happens, and that's not the case. I mean, 96 was before I even started trading. So in my trading lifetime, the Fed has never done that, but that doesn't mean that they've never done that. The precedent before has been for them to do what they're doing right now. All right, before we look at what's driving the market today and our trade idea of the day, I want to get your vote now. You've heard from me on what our market outlook is based on our technical routine that we have. What do you think about that? Click that link popping out in the top right corner of your screen. It opens up a poll, and then you can vote with either agree or disagree. If you disagree with my outlook there, scroll to the comment section and type in what you think. Like, what are you seeing that would suggest maybe we should be a lot more bullish? I would doubt there's too many people out there that have that take, but if you do, or if you think that we should be bearish, we should be taking risk off and maybe even starting to fade this rally. What are you seeing that would suggest that? Share with us down in the comment section below. All right, now let's talk about what is driving. And of course, today, very, very light day. Inflation has been the key word today. If you look at the economic calendar, you see the PPI. CPI was out yesterday, and it was relatively strong. But then you had a lot of Fed speak, talking where the Fed was basically defending the likelihood that they're going to cut rates, with the idea that they're going to try to get inflation to 2%, or maybe even a little beyond. But you can see, this inflation, here's the headline inflation, has really dropped quite a bit from what was 3.5% last summer to now down to almost 1.5%. Now the headline, or the core, peaked to right around this area above 2.5%, is now down to almost 2%. Of course, the CPI is the one. PPI will always be a little bit higher than what CPI is. And you can see even the CPI is down to almost 1.5% on a year-over-year basis, with the core flirting and staying right around this 2% mark, even with the decline that it's been having. So that's been the key topics of discussion. Of course, from a economic surprise index, the economic indicators as a whole, at least the ones that have had the most impact on like currency values here, they've been pretty negative. They can, even after this bounce, they're still pretty negative. So, it's not like the economy is going crazy here. In fact, if you look at the estimates, which were last updated on Wednesday, they'll be updated next Tuesday again. But you can see, we're under 1.5% year over for this annualized growth rate for the quarter. That's not really the highest level. So that's why the Fed's considering rate cuts, among other reasons. Why I've showed you before, inflation expectations and their declines to the downside. Here you look at here's the National Financial Conditions Index from the Chicago Fed, and very, very low. So I don't think we're in any danger of a recession anytime soon. If you again, the last time the Fed raised rate or cut rates with the it was right here with the S&P near all-time highs was 1995. At least that rate cut cycle. And you can see the financial conditions index then wasn't very bearish either, and we weren't even close. I mean, that was the 98, fall of 98, where things kind of really hit the fan briefly, and then they kind of stayed up here until we had the recession of 01, 02. And of course, the financial crisis and what it did, it was even worse. You can see we're not anywhere close to a recession type. And so the Fed's not cutting rates because they're worried about recession. They're cutting rates because of inflation expectations, which have gone considerably down. Here, let's go to the 5-year inflation break-even point. You can see since the last time they cut, even before the last time they cut, it was actually the second to last time they cut, is when inflation expectations peaked. They've been dropping considerably ever since. I mean, to the point where they were pretty much here on the way up before they started to cut. I mean, that was here in 16. They had only hiked it once at that point. They eventually hiked it one more time in 16, and then 3 times in 17, 4 times in 17, and 3 times in 18, or the other way around actually. But this was October of 16 was before they really started a regular pattern of rate hikes throughout the, starting in December 16 through 17 and 18. So the fact that we're back down there now, and that's pretty low relative to where they were all during this period here. So that kind of gives you an idea, and we only go back to 03 here, but that kind of gives you an idea of just how bearish we are. I mean, back here in September or August 10, when we were at this level, we had QE2. Over here in 2000, during the credit crisis or credit downgrade, inflation expectations dropped to 2%. We had Operation Twist, and eventually, by the end of 2012, we had a QE3 that kept inflation expectations way up here. But here, October 14 is when we started to taper QE3, and you can see what it did to inflation expectations. By the time we were done with it, here actually it was October 14 when we were done with tapering. We had tapered all throughout 14. We were done with QE3, and you can see what happened to inflation expectations after that. Well, we're lower than that. So that kind of gives you some context, again, as to why the Fed is so concerned about cutting interest rates right now. And if you look at bond prices have finally started to fall here, which means those yields are finally, in fact, this week is one of the first strongly bullish weeks we've had, and that's even with a little bit of a pullback, but finally bouncing off the 2% towards the 50-day moving average. In fact, I think there's a good chance we break through and start to fill in that gap up towards 2.4% on yields because of how considerably bearish we are. I do think that we'll test 2% again, and maybe even go a little bit lower with a divergent low point. So we're not out, the yields are not out of the woods yet, which means that we'll probably get more cuts than just this one. But again, you can see, where the 2-year yield was these other periods of time, or 10-year yield, excuse me, when, you can see, like, here's again where we ended QE3. We are lower now than we were then. We were obviously below 2% on the 10-year yield when we started QE3, and when we had the credit downgrade, we got down around to this level. So again, just shows just how low we are, and why the Fed is doing what it's doing, even though the S&P is at its all-time highs. Simply because, we've seen this before. We haven't seen it recently, but we've seen it before when the Fed's done that. It's actually happened quite a bit, and we just happen to be seeing it again. For whatever the reasons, trade wars, whatever the bearish reasons that have been for pushing the inflation expectations down, you've also seen it in commodity prices, right? You had this big drop in commodities here. Once the Fed stopped with QE3, then crude oil dropped off like a rock. So again, reflection of inflation expectations. They rallied, but they've been down, lower than they were when we had all this QE. Crude oil is down, and so again, these are relatively low levels for crude. Go back as far back as we can. These, we've been a lot higher than this throughout most of this past 15, 20 years. So relatively speaking, these are lower levels here. Now let's look at the sector performance, and we can see here today industrials, discretionary materials were your better performers today. If I were to take a look at the S&P 500 stocks and how they performed, your biggest winners were in some of these discretionary areas, retail stocks holding up really well. There's your IT stocks and some more retail doing well. There's your industrial stocks that have been outperforming today. So those are your two biggest winners to the upside. Dow and Eastman Chemical, along with CF and Albemarle, are the material stocks that are doing well, and of course your technology. So you can kind of get an idea of what's doing well and what's not. Of course, healthcare is your biggest laggard, and that we know why, right? All of these healthcare stocks, drug companies, with the rebates, that's been a factor for them. They're all really struggling big time today, and Netflix was also a big struggler to the downside today. So some consumer, that's why XLC is not up there with them. And you can see your other biggest losers are the ones that have the most to lose, right? Continues to have the most to lose. This over the last 200 days. Let's see if it's updated with today. So this is updated with today's. Over the last 200 days, real estate and utilities still have the most gains to pull back with these cyclical areas with room to run, and energy especially with room to take off. Now it didn't really take off today, but if the dollar makes a run, if the dollar starts to make a run to the downside, you can see it had a bearish week today and closed off with a downside move here. In fact, let's get to more of a daily chart on the dollar so you can see it zoom close up here. But you can see if we continue to push down here, then you'll see energy and materials work their way up to the upside along with industrials. It doesn't mean that these cyclical areas won't go up too, but you'll see these dollar sensitive areas really go up, and you'll see these interest rate sensitive areas decline as yields bounce back up towards what I think is more towards that 2.4% area again. All right, one stock in that industrial sector that had a little bit of a breakout, as you can see here on the chart, is Delta. Delta had a positive response with earnings, breaking out to a new 52-week high here. Good volume as well, but you can see the bullish market forecast pattern: bullish intermediate posture, rising green line, rising market sentiment with room to run. And then you look at like the 3 green arrow chart for Delta Airlines. And then you can see we have good volume, not surprising, coming out of earnings, breaking through a resistance level. So a little bit of a gap that we had, and then breaking through that resistance. If you look at the 2-line versions of that chart, you can see well up above. I mean, it's a nice good move. Now, is this a move that we want to like speculate on a strong bullish trade with? Probably not. That would have been more like even in this area when we had a little bit of a drop in sentiment and decline, but more likely in this area. So now we're breaking out. We can be bullish, we just can't be as aggressively bullish to the upside. The long-term chart looks really nice too. You can see, this is kind of a multi-year breakout that we're getting. So very good moving. The current momentum is high, but it's not nearly as high as we've seen before. So it's got some room to run to the upside. Not surprising for it to break out of its Bollinger Bands and being above the value area with all the volume here and this kind of inverted head and shoulders pattern. There's not a whole lot of resistance, and there's support down here below us that can hold us up. That's going to be key when we look to make that trade. The ADX is the positive directional index well above 25, the negative index well below 20. That's a pretty good trending move that we have here. Good opportunity. You can see from an Ichimoku standpoint, strong bullish trend, well up above its highs, breaking out. And again, from a trend strength standpoint, the long-term trend, see, the daily trend looks great, and that's kind of what we're looking at. Very, very strong, right? But from a weekly standpoint, it's been so noisy for so long that this breakout to the upside can start a trend. In fact, if I were to go back a little bit further so you can see some context here, when you've been really, really noisy, and let me see how far back I can really get going here. Let's do... Sometimes it doesn't fill in. There we go. So let's see if we can get delta in here. For some reason doesn't have all of these. But you can see when you kind of break out, you can, after being noisy for so long, you can really break out to the upside. Now again, I'm not banking on that type of move right now. We can get it, but I'm not banking on that type of move right now. I'm just banking on the fact that we can stay bullish, and that's again where it comes into just selling that 60 put and buying the 58 put for protection. That's where that blue line comes in. See, that's my break even. As long as we stay above that blue line, then we're able to maintain profits. And you can see below the blue line, there's a lot of support from volume and very little volume resistance up above. Can we pull back after this breakout? Sure. I mean, you see that a lot when you have breakouts. You get return moves in the short term. But as long as, it doesn't pull back too much, right? We've got all the way down towards, 59 essentially, because I'm willing to lose 51 bucks. I'm trying to make 51. I'm willing to lose 51 per spread. So that means I can pretty much go down to around 59 before I'd start to worry before I take a loss, small loss on this trade and move on. All right, well, that does it for today. You've heard from me now. Now let's keep this conversation going in our Market Scholars forums, specifically our Market Outlook forum on marketscholars.com. If you have any questions or comments about our video today, about anything we talked about or anything I didn't talk about that pertains to the subject, use that link and goes to our forums. You can post any thread, open up any new thread. You can also reply to anybody else's thread. That's the point of having a dialogue conversation. But let's keep this conversation going. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, click that thumbs up icon, and comment on our video. Follow me on Twitter for more content in between videos from day to day, and join our Market Outlook community at marketscholars.com, like I showed you earlier, or on Facebook with the group that we created there. Have a great rest of your weekend, everybody, and we'll see you all on Monday.